Hi everyone. So here I am back with another episode on the CFA technical series, and I am going to focus more on the fixed income portfolio management over the quite few weeks. Remember, level 3 the weights have increased on the fixed income portfolio management, so you can expect around 20 to 25% of the questions on the same. And if you do not have a very foundational understanding of this topic and subject, you are going to mess up in the essay portion of the exams. So in this episode, I'm going to focus more on the foundational aspects and introduction to fixed income portfolio management exclusively for the CFA Level 3 students. So this is CFA Level 3, Introduction to Fixed Income Portfolio Management, LOS 18A to F. Now remember, this is a foundational reading material and a very important reading material because it will set the ground for the next sessions or next LOS on the fixed income portfolio management. Also to emphasize that the weightage to the fixed income portfolio management and fixed income as a curriculum in level 3 is very high, roughly around 20-25% to 30% questions could be from the fixed income, and you might see that there would be more questions on fixed income than from the equities, unlike in level 1 and level 2. So let's get started. So fixed income, here we will read quite a few of terminologies and what differentiates fixed income from equities. So fixed income is currently the largest segment in the world of financial markets. And when we say largest, we mean in the financial markets. Otherwise, the largest is the real estate, but real estate is not counted in the financial markets. So quite a lot of you might not be aware of this, might be thinking that equities is the largest segment, but no, fixed income is the largest segment. Now the kind of fixed income instruments varies. So if you recall, there might be various kinds of fixed income instruments, and let me write down what comes to my mind. So there are bonds, right? Then there are private lending. So this also comes in fixed income. Then there is loans. So bank loans, which is not private, given by banks and financial institutions. Bonds, again, it could be sovereign bonds, it could be treasuries, and it could be other corporate bonds. Corporate bonds could be investment grade, high yield. Right? Now, all of these instruments, whatever you see written down here, they vary. They vary by what? They vary by two things primarily. Number one is maturity, and number two is credit quality. So whatever differences or different categories that you see, you would see that major differences is on either of these factors or both these factors, right? Then there are other differences, structural differences, such as there are straight bonds without any embedded options, right? So a typical normal bond, it can be a zero coupon or it can be a coupon bond. Then there can be instruments with embedded prepayment options. So embedded prepayment could be like callable bond. So what is callable bond? The borrower or the entity which has issued the bond has a right to call the bond at a particular point in time, right? So there is a call risk, and therefore if you see, the yield on these bonds is typically higher than the normal bonds. And then there could be variable coupon structures. So not all of these could be fixed. So coupon structure could be fixed and floating. Floating could be linked to a benchmark. The common benchmark we typically consider is LIBOR. Now Now let us understand what kind of benefits do fixed income instruments provide, and how does it benefit the overall portfolio as a whole. Okay, so the first benefit, and which is very significant, is it provides a diversification to the overall portfolio. Now, when you think about diversification, there are a couple of things that we need to discuss here. So, consider an overall portfolio of equities, fixed income, alternative investments, real estate, all the asset classes. And therefore, what we see here is fixed income has a low correlation with the equity overall. So, it has a correlation of less than 1 with the equities. And therefore, in a portfolio with high predominance of equities, adding fixed income will ensure that you have a lower standard deviation for the same amount of return. So now, in terms of the empirical evidence on the correlation between equity and fixed income, so there has been some research done there between 2003 to 2015. The correlation with the S&P 500 for the fixed income indexes were roughly between -3.5 to plus 0.36. And if you see in the current scenario, in terms of how the overall returns for the various asset classes have evolved over the past 3-4 months since the time when COVID situation started. So we have seen that fixed income has given much better returns, and equity has given a negative return. So you can clearly see that there is a less than 1 correlation here, right? Now, in terms of deep diving more onto the diversification side, it's important to understand what kind of diversification do investment grade and high yield provide. So investment grade is a more preferred fixed income asset class, primarily in the markets when there is more uncertainty, and therefore people resort to flocking to treasuries, cash, and then the third is investment grade. So investment grade is regarded as a more safe asset class than high yield, and high yield is more when there are positive prospects and overall market sentiments are positive. That is where when high yield will have a much higher demand. In an uncertain scenario or a stress case scenario, IG is going to have a higher demand. Now, let's look at a correlation of IG and high yield, etc., between each other overall. So what have been seen is within US, IG indexes had high correlation with each other. So very low differences there. Now, international IG was less correlated to US IG. And again, this is important because typically when global portfolio investors would invest in fixed income, they would diversify. Even if they have to invest in IG, they would diversify between US IG and then the other regions IG. In other, it is primarily the emerging markets. So remember, emerging markets IG will have a much higher yield here. But in a stress scenario also, global investors will flock to emerging markets IG. So high yield and IG are two different buckets within fixed income, and in a stress scenario, we will see that high yield and equities, they both have a high correlation. The correlation between them is high, and the correlation between IG and equities, this is low. Now let's look at the second benefit of fixed income, which is regular cash flow. So we all know that fixed income will provide regular cash flow to the investors and the fund managers. The regular cash flow will come in the form of a coupon. Now, what happens if, let's say, the investor has a portfolio of 0 coupon bonds? Now, in that case, he's not getting a regular cash flow, right? Now, if he has to build a regular cash flow by a portfolio of zero coupon bonds only, the suggested approach is to build a laddered portfolio. Remember, this was discussed in level 1 also. So a laddered portfolio, you buy multiple zero coupon bonds, 1 year, 2 year, and 3 year, so that every year some par is maturing and you have a regular cash flow here. Third benefit which fixed income instruments provide us is inflation protection. So you would be wondering how does a fixed coupon bonds provides inflation protection to us? No, they don't. So the caveat here is if you are holding a fixed income coupon bond, let's say a bond for 5 years, paying at the rate of 10% per annum, then it will pay 10% of par every year to you. So therefore, if inflation increases, your regular cash flows are going to remain the same. The regular cash flows won't change. Now, there is another form of bonds, which is the floating rate bonds, which provides the inflation protection to the investors. Now, floating rate bonds are always linked to a rate, typical variable rate, and this is LIBOR. So typically LIBOR is used in the market to price floating rate bonds, and it would be LIBOR plus 100 bips or LIBOR plus 50 bips, etc. And therefore, if inflation increases, LIBOR is going to accordingly change, and therefore your coupon, which will determine your cash flow for the next year, will accordingly change. So floating rates bonds provide inflation protection to you. But does it provide inflation protection on principal? No. So for interest, yes, it does, but for principal, it doesn't. Now there is another classification here, which is the inflation linked bonds. Now this is interesting because not all of you must be aware of this. So inflation linked bonds would provide both interest and principal protection on the inflation. So what typically happens is, in inflation linked bonds, your par amount will accordingly change. For example, if the initial par amount was 100 and inflation rate increase is 5%, then the next year your par amount will be 105. And therefore, if your, let's say, if your coupon on this is 10%, you would get 10% coupon on 105, which is 10.5, and not on 100 originally. So your both the coupon and the principal payments are protected here. So just to summarize here in terms of how does each of these instruments provide protection. So fixed income bonds, if you see here, they provide no protection on inflation. Floating coupon bonds, they provide protection on the coupon, but they don't provide protection on the principal. Inflation linked bonds, they provide protection on both. So now let's look at the next LOS subsection. So this asks us to read how fixed income mandates may be classified and compare features of the mandates. So we will look at fixed income mandates in this subsection LOS. So there are two kinds of fixed income mandates. One is the liability based mandate and the second is the total return based mandate. So total return is simple. Imagine a portfolio manager or a fund manager managing USD 500 billion of fixed income portfolio, and his objective is to just generate a return and exceed that of the benchmark return. So this is a total return mandate. A liability based mandate is where institution has to regularly pay some liabilities, and therefore they need to generate consistent returns or regular returns to meet those liabilities. Example would be insurance firm or an asset management arm of an insurance firm. Now let's break down these mandates and try to understand how does a portfolio manager behave in each of these mandates. So let's first speak about the liability based mandate. Now, a liability-based mandate again are classified into 4 categories. So, and remember, this is very important section of the fixed income foundational course to deep dive into the later course, and you will see a lot of essay-based questions coming on these mandates related sections. So now let's come back to the liability based mandates. So how does a portfolio manager ensure that the liabilities which are due, the fund or the institution is able to repay those liabilities as and when it becomes due? So one is cash flow matching. So as the name suggests, this is very simple form of liability based mandate wherein I know that in year 1, 2, 3, X amount of liabilities will be due. And therefore, I prepare a portfolio of fixed income in such a way that my cash flows, which are generated in year 1, 2, and 3, are roughly equal to the liability payouts due in year 1, 2, and 3. Now, let's move on to the other second liability based mandate. The second is duration matching. So remember, cash flow matching is a difficult form of liability-based mandate because you have to find out and screen certain instruments which totally fit into these kind of criteria. So what is the other alternative solution is to match the duration of the assets to the duration of the liability. Now, what that means is that the portfolio is immunized or is immune to any interest rate changes because the duration of assets and liabilities are same. Therefore, the interest rate effects on both the assets and liabilities portfolio is going to remain same, and hence the firm is immunized. Now, let's go to the third form of liability-based mandate, which is known as contingent immunization. So contingent immunization is a hybrid of active management and immunization, right? So you want to reap extra benefits of active management or extra yield generated by active management, but still you want to immunize the portfolio also. So what it typically does is initially the portfolio is funded with a surplus. So the present value of assets is greater than the present value of liabilities, which means that there is a surplus. Now this surplus is managed in an active way. So the portfolio manager would be taking active calls or different calls versus the benchmark in order to generate higher return than the benchmark. So this surplus would be managed in an active way. Now there are two scenarios which can emerge from here. One is the surplus grows and the other is surplus declines. So if the surplus grows, then it is well and good, win-win situation for everyone. And the surplus continues to be managed in an active way. Now, if the surplus declines, which means that there will come a point when present value of assets is equal to present value of liabilities. As soon as this is triggered, the fund manager or the portfolio manager will immediately resort to the normal immunization. Now let's look at the fourth and the final form of liability-based mandate, which is horizon matching. So horizon matching is a hybrid approach, and it is nothing but a combination of 1 plus 2, which is cash flow matching and the duration matching. So what happens here is the short-term liabilities, they are cash flow matched. And the long-term liabilities, they are matched by duration. So it provides an additional level of security, but it also provides an additional level of flexibility by bringing in duration matching on the long-term liabilities. So if we see and compare horizon matching with cash flow matching, it should cost less than pure cash flow matching, because a large part of the content is duration matched, which is lesser costly, but slightly additional risk might be there because of this factor. Let's look at this question and conclude the liability based mandate. So the question is, if the yield curve experiences a one-time parallel shift, what is the likely effect on the match between portfolio's assets and liabilities for both duration matching and cash flow matching approach? So what it is saying is, this is the yield curve, right? Say the yield curve is this. Now it's saying that it experiences one-time parallel shift. So let's say it shifts to somewhere here, right? Now what is the likely effect on duration matching and cash flow matching approach for the fund assets? Now cash flow matching. So cash flow matching, what we discussed, we match all the cash flows to the liabilities cash flows. And therefore, cash flow matching has nothing to do with how market reacts. So this is, you don't need to worry about how market reacts when implementing a cash flow based matching approach. Now, when you actually match a duration based matching approach, that is where you need to be worried about the market changes. But what is happening here is a parallel shift is happening. So both assets and liabilities will be affected in a similar way when the parallel shift in yield curve happens. So effectively, there will be no change on the duration matching approach also. Now let's take another perspective. Let's say the yield curve did not change parallelly, but let's say it changed in like this way or some other curvature. Now in that case, what we would have done is primarily that both the assets and liabilities would react differently, right? Because even though the duration is same, but the exposure at each level might be different. For example, in this curve, the assets might be largely here and less here. Liabilities might be somewhere here and here. Even though their duration is same, but their weightage of the funds into each brackets of the yield curve might be different, and therefore the effect might be different. I hope you understood and appreciated the overall liability-based mandates. This session concludes the liability-based mandates. And just to recap, there are 4 liability-based mandates: cash flow matching, duration matching, contingent immunization, and horizon matching. The last 2 ones are the hybrid ones. Now let's look at total return mandates. This is another mandate. Remember, the first mandate was the liability-based mandate. So total return mandates, they do not seek to fund future liabilities. So what they target is either an absolute level of return or a return to exceed the benchmark, so relative to the benchmark. Now, there are again 3 kinds of total return mandates, and let's discuss those 3 kinds. So one is pure indexing. So pure indexing is nothing but it will replicate the performance of a bond index. So let's say there is a US high yield index, okay, and let's say it has constituents of around 100 corporate bonds which are high yield. Now what this will do is it will replicate the entire index altogether, right? So now the problem here is that in fixed income, the liquidity might be an issue. Therefore, total duplication of the index might be totally impractical, right? So what alternative do fund manager deploys? They match all the risk factors of the index. So when we say the risk factors, it would include all the factors like duration, credit quality, the sectors, etc. So all these factors would be absolutely matched with the benchmark, and it would be a pure indexing mandate. Now let's look at the second one. So second one is the enhanced indexing. So as the name suggests, it's a slightly advanced version of pure indexing, where in order to add some modest active return, the duration is largely matched, but some risk mismatches are allowed. For example, if a portfolio manager is benchmarking a high yield index, and if I believe that energy sector is going to not to do good over the next few months because of the oil prices, then what I will do is I will have a lower weightage of energies credits in my portfolio and higher weightage of, let's say, the stable names or the staples, consumer staples name. So what that means is the fund manager still has got some flexibility to play around with the sectors, etc. But the duration, which is the biggest risk in any fund, in fixed income fund, is largely matched. Now, third is active management. So as the name suggests again, so this is pure active management where the fund manager has a discretion to change anything. So if he believes that a longer duration portfolio is more suitable to his need based on his interest rate expectations, then he will increase the duration of the portfolio. He can play around with any factors of the portfolio in order to generate a return which will be higher than the benchmark. Now, in terms of what kind of questions could come in the essay portion of the exam, next exam is primarily, if you see that right now in the current scenario, high yield is being discouraged. So we have seen lower high yield index return over the past few months. Roughly year to date, high yield has returned a negative return. We have also seen IG and treasuries being preferred. Now, a typical essay question that could come is an example of a portfolio fund manager could be given that in this is the scenario and this is how the economy is going to perform, or this is the economic prospects, and what do you think as an active manager, which factors would you play around with, and how would you position your portfolio?